Hi, it's Jeffrey Cohen, President, Founder, and Investment Advisor Principal for U.S. Advanced Computing Infrastructures Incorporated. We're an Illinois registered investment advisory firm. We do non-discretionary work. If you ask us to invest your money, we invest it through Charles Schwab as our custodian. We sell a market newsletter based on the Chicago Quantum Net Score, and that's also what we use to manage the money. So we're going to talk a little bit today about the market and what we saw. And so I created a little letter. And I guess, you probably can read pretty well. I'm going to show it up there. I'm just going to tell you what I'm going to tell you. So the historic price volatility in our model, it went up a little for stocks. Not all stocks. The S&P 500 still looks better. That's on the left side of the screen. I'm going to make that really big. And so your expected market return is down a little bit from yesterday. That's the return for risk. It's 5.75%. You would add that to the 5.42% risk-free rate on 13-week treasury bills. Could be 17-week as well. And that's what you get for the total return. The variance of the S&P 500, 1.422 times 10 to the negative fifth, is down slightly. And that trend has been down 6, 8, 9 months. It just keeps falling. So, ran our model on 10,507 stocks. 4,941 passed the first round of validation. Final round of validation, 3,279 stocks. 3,279 stocks. That's a lot of stocks, by the way. And the variance is 3.172, which is slightly higher. So usually that runs about 2 times the variance of the S&P 500. 1.4 times 2 would be 2.8. We're at almost 3.2. We're getting higher. The expected return of all the stocks is 12.5%. That's including the risk-free rate of return. That's down a little. So I'm a little nervous when I saw this. I saw this last night. Talked to my wife, Diana, and I said, Diana, I'm a little nervous about this. Then we look at the top 50 stocks. And this also made me a little nervous. Let's make sure this is the right day's data. Hang on. Yeah, 12.6. So it's based on market close last night. So the 50 best stocks with the lowest, or actually the best, sequence score, you have Open, Affirm, Skills, Redfin, Upstart, Comp, Wish, Fubo, Sunrun, Cloudflare, Wayfair, Carvana, Unity. You know a lot of these. Marvel Tech, Caesars Entertainment, Lightspeed Commerce, Sonova Energy. I mean, some of these are real small caps. Some of these are real runners. Lots of new economy in there. Lots of new tech. But what's important to note is, it's hard to tell from here, but numbers are getting smaller faster. And so if we pull over the spreadsheet, which our clients get, it's basically every stock that we go through. By the way, these are the largest cap stocks. I always find that interesting. But let's sort it back to the Chicago Quantum Net Score. Ascending. The thing you're going to see, which disturbs me a little, number 40, where the 41st stock is the S&P 500 Index ETF. Why does that disturb me? Because it used to be closer to 50. And so, all right, maybe not that big of a deal, but 10 stocks just got crowded out. Stocks like the Carlyle Group, Carnival, Intuit, Adobe, Apple, Berkshire Hathaway, BlackRock are no longer better than the S&P 500. So your high dividend, lower risk stocks fallen a little behind. Okay. So what do we have? We have Lending Tree, for mortgages. T. Rowe Price, You have Block and Shopify, you have Blackstone, you have C3 AI, and then you got the stuff that we talked about, kind of the real risky stuff. So it bothers me because there are fewer stocks that score better than the S&P 500. Fewer. So there's only 40. There are now only 40. I think last time I ran it, there were 50. The value of all the stocks that are captured in our model, all 3,279. You take market cap, you highlight it, you look at the sum, and it's 50.9 trillion. Yesterday it was 51.4. Day before. So that means we lost $500 billion of market cap in one day. That's not great, right? Now the negative beta stocks are different. There's a couple things here that really gave us pause. And I'm sharing them with you kind of raw because I want you to see it the way I see it. I thought about this a lot last night. You got really weird negative beta stocks. American Battery Tech, Concora, Enzo Biochem, Hempico, Lemiradex, Ramaco, Sadat, Safety Shot, Wisa, Maywu, Aptech Payments Corp. So I'd never heard of any of these stocks. These are a bit odd, a bit anomalous. And so, fine. Negative beta stocks are different. They're kind of no name, right? Or at least new to us, not familiar names. And the best long stocks are starting to change, right? And so we see more risk and we see less dividend. That's just interesting. Interest rates did not change. Now, today after hours, I looked and it looks like risk-free interest rates lowered. But as of yesterday, they hadn't changed. So it wasn't that caused the change. Expected return to stock market risk is a little lower than before. That's what we talked about earlier. 5.75% expected market return in a year, inclusive of dividends, versus just throwing your money in a 13-week treasury. So 5.75% annual return over U.S. Treasuries. Treasury bills, not bonds or notes. That's a little low. That's a little lower than I would have expected. And then when I looked at all the stocks, it was 12.53%. That's actually doing the math and going through the whole process for all stocks. And that's because the beta, I'm going to throw this stuff in here too. Oh, don't do that. I don't want them big like this. Format, body. There we go. That's better. By the way, the sound that you hear is the sound of pumpkin. And you'll know pumpkin because on Twitter, there was a young boy who's going through surgery. And that young boy wanted pictures of kitties when he woke up. And I felt bad. And so I immediately, within a minute, sent a picture of Pumpkin because Pumpkin was looking out the window. It was a nice picture. And hopefully Joey saw it. I hope so. I hope Joey's feeling better, right? And so you're hearing Pumpkin now. Let's see if I've got a video. I got a picture of him there for you. Yeah, here's Joey. Here's Sophia. Here's Pumpkin. So what you're hearing in the background is Pumpkin. That's fine. That's not what you came on the call for, but figured I'd share it with you. What else did we get in here? Yeah, so this is important. The average beta of all the stocks is 1.22, so it's greater than 1.0. So what it means is that the stock market is a little more risky than before. Your average volume is 112%, and your average share price is 97% of what it was a year ago. So volume's a little high, beta's a little high, Market cap lowered, although it is very high for right now. The stocks have been going up a lot. And your average share price is 97% of what it was a year ago, which means stocks are up. And we're not just talking about the big seven. We're talking about 3,279 stocks are all trading at 97% of the average trading price for the past year. Think of that as a 253-day moving average, and they're all right at that level. That's crazy. So the last thing I saw, when the market opened and for the first hour, the most risky but valuable stocks were trading lower except for Google, which must have had news because it was up 5%. But by the end of the day, these stocks had all recovered. And so for the first hour, the market dumped. And it didn't dump every stock, it dumped the most liquid. So why did it do that? Who's getting out? Who had the same idea that we did, that today was a day to start dumping, to start finding exit liquidity, to start raising cash? Because the market isn't quite where you expect it to be. But by the end of the day, everything was fine. Market's kind of even a little bit up, right? It's interesting. So these are the notes, right? So let's go through some other things. S&P 500. So this is the chart that I had up today on my desk. I reviewed it yesterday with you on a video. Let's look at it today. So if you look at this chart, it's a one-day chart. And you see that the S&P 500 has been range-bound. Lower range between about 3775 to 4100, and then upper range bound from 4100 to about 4600. And you can see that we've bounced nicely, and then all of a sudden, boom, we're testing that top, and we've been there since November 22nd. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 trading days right at that line. So you could say we're building a solid base for after it plows through, that it won't come back down through 4,600. But we look at it as, if the market was intending to go higher, it would have. And for some reason, it doesn't want to go higher. So I look at that. I look at the riskiness of individual stocks. I look at some tricky trading volumes, and I say, all right, that's where we're at. So some other stocks that we follow, and we've made videos about, like Skills. What's interesting about Skills is nothing happened. So you can't really make money trading Skills. It's just not moving. Digital Turbine's another one that we like to follow. We're not in it, but we like to follow. And this thing hit about 444, has recovered nicely. About $6. And now is maybe coming a little bit back down, but still not a lot of movement. There was a big day, Monday, the 4th. And Affirm Holdings is another one. Affirm Holdings has been relatively flat in the $15 to $20 range, 15 to 24. And then boom, took off. Is now almost $40. And so some of those candlesticks are pretty large. If we take a look at the monthly, you can see they're starting to get pretty large, like a buck or two. Average daily trading range. There's a way to find that out. If you go to FinViz and you type in Affirm, and you come down here, ATR, average true range over the last 14 days is $2.41. So Affirm is moving a lot, right? And is moving up. But what I've noticed is Affirm has been pretty flat with the S&P 500. So the S&P 500 has been flat since the 22nd. Affirm has been, it's soared higher, but now has flattened. And so it's possible. It's possible that it's just kind of riding and waiting. So that's another stock that we like to watch. And so shut some stuff down. So this is my new picture. I hope you like it. It's an AI generated picture. We described ourselves, and this is what the computer saw, and so we're pretty happy with it. What else do I want to share with you? I think the big thing to notice, and if you look at our very, very childish doodles, I realized I needed to draw this one as well. You've got a pretty interesting head and shoulders here. And at head and shoulders, if it breaks the head, this thing could soar higher. There's no volume confirmation, by the way. A little bit here, a little bit of extra volume at the top here, and a little bit of extra volume here. And now volume is falling, and so now you see weakness on falling volume. And so, I mean, it's interesting because the market rose. So you've had plenty of time to make money in this market. Market rose, right? Plenty of time to make money. This is back in November, up and down, higher high, lower, higher lows, higher highs. Then a little flat. And then here's where it really tried. It really tried to break out to 4,600. And then not so good. That was in the summer. It's been down, and you can see here there was like a little bottom set right here where it tested the same level we were at here. Which is why you get that line, why we drew that line, right? And then it's right at roughly 4,100. So what are you going to do? You might actually test 4,100 again if it doesn't break out. So nervous, right? What else do I want to share with you? Let's see what else is up on my screen. Hopefully it's nothing real bad. By the way, we have no position in any stock right now. No options, no shorts, no longs, no nothing. And so I just want you to know that. We have no conflicts right now, which is wonderful. So I guess one thing to talk about is we have a coupon code, QED-C or QED-C. And that coupon code gets you 90% off our Chicago Quantum Net Score analysis, either your daily long or your daily short. That's what